Happy Tuesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, November 5th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, will the U.S. presidential election cause problems for asset markets? Our answers are, polls officially open up today for the loudest U.S. general election in modern history, with candidates from the top of the ticket all the way down ballot barraging American voters with ads that heavily featured fourth-turning style existential rhetoric. The probability of sedition leading to social unrest, nullification, and eventual succession is dramatically higher than the average investor realizes. On our list of quant signals that could cause problems, the VIX just broke out to bullish VAMs. Currently, the MOVE index, which is bond volatility, the CVIX, which is currency volatility, the VIX, which is equity volatility, and the VVIX, which is the volatility of volatility, are all bullish from the perspective of our volatility-adjusted momentum signal. These factors are contributing to risk-off inflation, currently garnering the second largest degree of support from asset markets via our global macro risk matrix, which is the quantitative tool we use to nowcast a market regime. A transitory risk-off market regime that develops quickly and persists over the next month or so is a reasonable probability. We are still buyers of any dip until our fundamental research summary is materially revised, but it could be another 4 to 6% lower from here in SPY price terms. Transitioning to our 42 macro dashboard, as always, we'll wrap up with the question from our community. This one's regarding fixed income. It says, hello, Dean. Hope you had a relaxing weekend. Would it be accurate to say that based on the data, your outlook is most bearish on long duration treasuries, while you hold a comparatively less bearish view on short duration corporates and bank loans? If so, would these factors potentially offer the best risk-adjusted returns within the fixed income allocation? Excellent question. So in terms of our, just to take a step back, we are bearish, certainly on a relative basis, and generally underweight long duration treasuries. I don't think that's a particularly novel view. It sounds like most folks kind of generally agree with our view, our forth-turning research that suggests that, we're likely to see monetary debasement, financial repression, elevated rates of inflation, big blowouts of the sovereign debts and deficits. All those things are core conclusions of our investing during a forth-turning regime analysis, which we've been publishing in every monthly macro scouting report since last summer. So the key takeaway from that view is that investors, you're probably not going to get paid on a real basis being long duration treasury bonds, which are currently mispriced relative to a lot of those risks, and also mispriced relative to the lack of term premia that we are currently observing in the bond market. The 10-year yield should be somewhere around 5.5% currently, based on if you remove the influence of the Fed's bloated balance sheet and other regulatory policies from the treasury market. And so in our view, the balance of risk is skewed to the downside in treasury bond price terms. We may not get those price declines if the Fed continues to maintain an asymmetrically dovish reaction function. But the reality is, if the Fed maintains an asymmetrically dovish reaction function generally and persistently throughout the duration of this fourth turning, which historically it has in a fourth turning, because you got to find you got to financially repress people into the treasury market amid elevated rates of inflation. If that does do that, then you're talking about other asset classes, stocks, credit, crypto, even commodities, all outperforming long duration treasury bonds on a long-term sustained basis. And so, going back to the question, that does suggest corporate credit is likely to outperform long-term treasury bonds on a sustained basis. And that's, in our opinion, that's probably what does offer the best risk-adjusted returns within the fixed income space. So bank loans, short duration corporates, anything that has low duration risk, so not long-term investment grade credit, corporate credit, which has a lot of duration risk and will trade very similarly to long-term treasuries. You want to find things that have less duration risk, which are higher yielding securities, which are obviously you're talking about high yield credit, bank loans, et cetera. So that's our long-term view on that. And obviously these are longer term thematic views. We're still always and forever going to respect the evolution of the market regime. There will be a time where it is okay to be long duration treasuries for recession trade, but there'll also be a time, and there'll be a time where you want to be short and or out of those credit type instruments. But right now, as long as we're in a risk on market regime, we do believe that you got to continue to anticipate that the longer secular trend for the relative dispersion of these asset classes continues to widen, i.e. treasury bonds continue to see share in nominal price terms to things like equities and credit. So that's our take on that. If anyone wants incremental, anyone wants to view the analysis supporting all those conclusions, obviously can source our monthly macro scouting report. Our most recent macro scouting report was out Friday afternoon, well received by our clients as always. So we'll wrap it up there. Darius Dale presenting our macro minute for Tuesday, November 5th. 2024. Everyone, a wonderful day out there. Best of luck, and let's have some fun with this fourth turning election. Could get hairy here in the U.S., and I'm kind of half joking, but I'm also kind of not. So let's see what happens. Have a great day out there, my friends. Cheers.